Ladies and gentlemen, all hell is about to break loose, and that's what we need to talk about here in this video, specifically what the bond market is telling us, and how do we make money from this hellish investing landscape that is about to come. When could this come, and how could this affect stocks such as AMC or your higher risk stocks, a lot of stocks that we invest in. After all, if you are the little guy here and you're not a multimillionaire or a billionaire, you're probably in some riskier names. How is your portfolio going to be affected over the next coming months? It's vitally important that we talk about this. It's vitally important that you understand what is coming and what the bond market is saying, because typically the bond market is not wrong. So we're going to get into it, guys. Hit that like button and subscribe to the channel if you learn anything out of this video. If you like to make money, if you want to grow your portfolio, if you like AMC, you want to see AMC squeeze, or any of those reasons apply, it's free 99. Hit that like button and subscribe to the channel. Now, let's get into it. And first things first, I want to talk about this. Nearly 100 billion in deposits pulled from banks. Officials call system sound and resilient. Doesn't sound very sound and resilient, and a lot of people are just waiting for the next domino to fall, whether it is First Republic, Deutsche Bank, or Pacific Bank Corp. Any one of these companies are really on the chopping block here. And the interesting part about all of this, you are about to wrap up Q1, and who reports earnings first? Well, it's the banks, and that could give you another big round of fear for the stock market. So that's really what I'm looking at next, is going to be earnings season, because after all, stocks can trade off of fear and greed. They can get excited because we think the end of rate hikes is coming, even though a recession is guaranteed at this point. Markets can be ecstatic for a while, but once earnings start to come in worse than expectations, that's ultimately the number one thing that matters in the markets. You're an investor. You're investing in businesses that seemingly should be doing well. If they're not doing as well as you thought, that's going to mean a rapid repricing of valuation. So number one, I'm going to give you guys that right off the bat. I think the next big catalyst is going to be earnings season. Now, as well as earnings season, you're going to get CPI coming over the next week and a half here, and that will also be very important. But earnings season, when it comes down to it, is going to be massive, because the markets, they're not cheap by any means right now. Now, let's go ahead and play this video for you guys. This guy breaks down what's happening in the bond market and what kind of danger it is sending signals of. And then once we're back, we're going to get into exactly what this means. So let's go ahead and roll that video right now.
In the way that whole yield structure has really gotten to some dramatic extremes. Talk about that a bit.
Yeah, thanks for having me. What we've really been paying a lot of attention to since last year is this relationship between the Fed funds rate and the 2-year yield. And so this is a great proxy for forward Fed policy and during crisis periods of financial stress. And so most recently, we've seen that spread drop below 100 basis points, and this is absolutely rare. You only see this right before crisis events. So we went back and said, when does this spread blow out to 75 basis points or more? Really, it's a handful of cases. The S&L crisis, the 1990 recession, long-term capital management in 1998, 2001 recession. We saw 2 of these in the great financial crisis, one in 07, one in 08. We saw one in the 2009 repo crisis, late 2019, and then again right before COVID. So they happen right before crisis periods, this blowout between the Fed funds rate and the 2-year. And always, in every case, the market is saved by the Fed. The Fed cuts rates within weeks, or at least at the most a month, following this huge inversion. And what we saw is the Fed hiking rates just this week. And so this is odd. We're off the map. We've never seen this kind of behavior from a Fed when we have this kind of a signal from the bond market, and I would say it's pretty ominous for equity investors.
It's fascinating. I would look at that list of prior instances and maybe push back and say, obviously, they were dramatic in the moment. They were scary. There certainly was more risk they came along with. But S&L crisis, what, 1986, right? The economy seemed to weather it okay. 1990, shallow recession, 20% S&P drawdown. Even 1998, some people say the Fed got too easy too quickly given how strong the U.S. economy was. So I wonder if you can say that you don't necessarily have to have the Fed immediately go into panic mode in order to avert a bigger disaster.
Yeah, well, it's hard to always argue the counterfactual and know how history would have turned out if the Fed didn't cut rates. But in fact, every single one of those cases, the Fed absolutely responded to this inversion. And so, like, let's think about 1998 and the LTCM for a moment and think about how much different the backdrop is. Because I see bulls making the case that, hey, the Fed could come in, cut rates right now, and this could reinflate the bubble. Kind of similar. We were up 30% off the inversion for 1998. And so is that possible? Well, think about back then, CPI was sub 2%. Oil prices were at like $15 a barrel. And the 2 months after that crisis, when the Fed cut rates by about 75 basis points following LTCM, oil prices dropped below $10 a barrel on Brent to make a generational low. So there were a lot of tailwinds within the inflation picture that are not present right now to give the Fed leeway to cut back then.
Now, isn't that something? And the markets really didn't care about this last week. Markets are just more focused on the Fed not raising rates anymore. They're not focused as much on how deep this recession is going to have to be to get inflation, down to 2%, and the signals that the bond markets are saying. And essentially what's going on here, and just to break down what he said in a little bit more English, the 2-year bond currently pays you 3.77%. The Fed funds rate is 4.75 to 5%. That should not happen. That is telling you the markets are pricing in massive rate cuts towards the end of this year. The only way you get rate cuts is if inflation comes down or you go into a very severe recession, because recessions will bring down inflation. But you don't get easing of Fed policy here without a dramatic decrease in activity, right? In spending, essentially a recession. And he goes on to say that other times this has happened in history, 1998, 2001, 2007, 2008, in more recent history, that we didn't have inflation problems like we do today. Commodities were at very low levels. We just didn't have the same problems. So we've never seen this before, and potentially setting us up for a very rocky second half of 2023. Could be sooner rather than later, and I think that really comes down to how earnings are with companies. So that is a big first part of this video, and now that that is out of the way, I want to get into how this will affect your risk on kind of stocks, how this could affect AMC in a very positive way or a negative way. Now, first things first, you got to know about recessions is people will cut back on a lot of things, but people don't like to cut back on experiences, on having fun. And so, believe it or not, if you're invested in AMC, the theater business itself might do just fine, right? You might not see movie theater, movie studios, I should say, making as many movies, and that would be reflected like a year or two, after the recession starts, right? Because it takes a long time to make a movie and send it to theaters. These movies coming to theaters have probably been done for a while now, so you're going to have supply of movies, and I doubt the fundamentals of something like AMC would be dramatically affected by this recession, unless this was like a Great Depression event, which I'm not going to sit here and forecast that. Even though the bond market is saying something like that is possible here, I'm not going to forecast that, and nor would I want that to happen to average families and people. So I'm not going to sit here and forecast that. But for other high-risk stocks, if they are not profitable, it's going to be a rough time. Now, More specifically, in relation to AMC, this can give you some margin calls down the line. Once the recession actually does start, you're going to see a cutback in lending. You're going to see hedge funds really want to shore up their balance sheets as well. And something like AMC, you need a lot of collateral to be involved in shorting AMC. So there's a lot of money on the sideline that could be uncollateralized. You could get your money back, and that would seem like the best trade from there, because it would be like comparable to shorting technology during COVID, right? You didn't want to do that because people were at home, right? Not the short. You shorted other things. You shorted restaurants. You shorted airlines, cruise lines. You shorted oil companies. And why I'm making that comparison is because your leisure and hospitality, your recreational kind of companies typically do okay during recessions, right? At least initially. And that would just not be the place you would want to short. More or less, you'd want to short oil. Comes down during recessions, right? And Apple would definitely not be good to be invested in during a recession, even though it is probably the most sound company in the world. You guys are getting my drift here. At least at first couple of months, first year or so of this upcoming recession, AMC will probably do just fine. Going to the movies probably ain't the first place people actually cut back. So in that regard, you can get a short squeeze event. Now, from now until a recession starts, which is probably summertime, which is probably mid to end summertime, probably Q3 2023 or Q4 even, there's going to be a lot of changes overall with AMC. And I think this court litigation, obviously we've talked about it many times now, is going to give us a rally. Or if we do get a 1-for-10 reverse stock split and AMC does raise a lot of capital, that as well will give us a rally, in my personal opinion. So there you have all of that information. On top of that, I want to touch on this. So Federal Reserve data showed the bank customers collectively pulled $98.4 billion from accounts for the week ended March 15th as Silicon Valley Bank and Signature Bank failed. Officials at the Federal Stability Oversight Council meeting in a closed session Friday insisted the system remains sound and resilient. Doesn't really look like it. If you take a look at the Fed balance sheet, it's actually went up another $100 billion. So this is equivalent to this closely, or the dollar amount is very similar to what you've seen during the crisis of 07 and 08, or 08, 09, whatever you want to call it, of essentially the bailout numbers that banks needed to see. The balance sheet has went up by about $400 billion. And like I said, it's up another $100 billion just in the past week. So this is not a good sign. This doesn't look sound and resilient. But again, we're waiting for the next domino to fall. Now, on top of that, in relation to the bond market, right? This is the bond market. You are seeing the 2-year and the 10-year yields, the spread or the inversion, is uninverting even more, and this is very bad. This means the 2-year bond is continuing to fall, and that's something that we just talked about as well. And the 10-year bond is rising. So you're starting to get a more normalization of the yield curve, because when the yield curve is inverted, that shouldn't happen. You should never get paid out more for a 2-year bond than a 10-year bond. And what that is saying is that when the 2-year bond pays you out more than the 10-year bond, you're going to get inflation. You're going to get Fed rate hikes, right? People are propping up that 2-year yield. When it starts to fall like this and normalize, that starts to price in some economic pain. And it's usually not the inversion that is painful, in which, I mean, 2022 was a pretty rough year, so it was kind of painful. It's the steepening of the yield curve. It's the uninversion. It's the normalization of the yield curve that is ultimately the most painful part, guys. So that is going to do it for this video. Hopefully you guys learned something. If you did, hit that like button, subscribe to the channel, and if you have any questions, leave them down below in the comment section. I'm going to try my best to answer all of the legitimate questions that you guys have down below in the comment section. So that is it. Thank you guys for watching. Enjoy your weekends, and I will see you in the next one.